Alright, this video covers Individual Tax Chapter 1, Learning Objective Number 5, which begins on page 10 for the 2018 textbook. And these are filing statuses in tax computation. So we have several different filing statuses: single, married filing jointly, married filing separately, head of household, or qualified widow. So single means that you are single. Now let's talk about the difference between single and married, or married filing separately, married filing jointly. Whatever your marital status is at the end of the year, that's what you're going to choose. So if your divorce went through and was finalized in December, then as of December 31st, you're single again. However, if you're still married as of December 31st and your divorce is not finalized until January or some other time, then you're still married. If you've agreed to do a joint return, great. If you haven't, if you're married filing, then you would do married filing separately. So that's the distinction there. Let's say that you get married on December 31st at 11:55 p.m. So you're only married for 5 minutes during 2017. You still are married as of the end of the year, so you can choose married filing separately or married filing jointly.
Let's see, there are some rules in pages 10 and 11 about those filing statuses. For married filing separately, actually let's talk about head of household first. Head of household usually means that you are not married, but you have a dependent, usually a dependent child who lives with you. Then you could file as head of household, which will give you some extra benefits. This was one that they originally, when Congress had talked about changing the tax code, they were going to get rid of head of household. I'm glad they didn't. It's still here in this new tax law that's going to come into effect in 2018. But so head of household, you have to be unmarried, or what they call an abandoned spouse, which I'll talk about in a minute, as of December 31st. And you have to pay more than half of the cost of keeping up the home that was a principal residence of a dependent child or other qualified dependent relative. We'll talk about qualified dependents in another video. So abandoned spouse, let's talk about that. That's at the top of page 11. I highly recommend you highlight this, because in order to qualify as an abandoned spouse, you need to meet 4 different requirements. The first one is a separate return is filed. So you can't be an abandoned spouse if you're filing a joint return. That kind of makes sense, right? The taxpayer must have paid more than half of the cost to maintain his or her home during the year, and that home needed to be the principal residence for a dependent child or dependent relative for over 6 months during the year. So more than 6 months of the year, the child had to have lived with you. So let's say that you separated partway through the year. You separated in March. So for March 1st, so that's all of March, April, May, June, July, August, September, October, November, December, 10 months. So that's more than 6 months out of the year. That was the home of a dependent child, and you paid more than half of the cost of living there. Also, the spouse did not live with you for more than 6 months, for the last 6 months of the year. So if your spouse moved out in September, you cannot qualify as an abandoned spouse. You're going to have to do married filing separately, because chances are the divorce is not final yet. So that's one of all of those tests need to be met in order to be an abandoned spouse. And what that means is that if you qualify to be an abandoned spouse but you're still married, you can still file as head of household, which gives you a higher standard deduction. That's kind of cool. That's kind of important. The last one is qualified widow. Qualified widow, where are the rules for that? They're listed at the bottom of page 11. So to be a qualified widow, number 1, your spouse already died. So the year your spouse dies, you can still file as married filing jointly. Or if you always filed married filing separately, you could do that as well. Well, the year that a person dies, they still have to do a tax return. So you were still married during that year. Even though they died during the year, you're still married filing jointly. So let's say it's 2012.
is the year that your spouse died. So in 2012, you filed as married filing jointly. And you've got kids who live at home, dependent children. So in 2013 and in 2014, you can file as as a qualified widow. That gives you some, not all, some of the benefits of the married filing jointly. Basically, you get the same standard deduction as married filing jointly receives, which is a good thing. If you don't have any dependents, then nothing changes the year the spouse dies. You're still married filing jointly. But if you have no dependents, afterward you become single. You wouldn't be head of household. You wouldn't be head of household. You wouldn't be qualified widow. So this qualified widow only works when there were children, dependent children, in the mix. The last thing in this video I want to talk about is the tax calculation. So you're going to need your textbook. Your tax tables are in the Appendix A. So here's where you probably want some of those tabs. And I'm turning to page 12 in your textbook. And I want to do a couple of calculations. The first one is the second example near the bottom of the page. It says Meg is a single taxpayer during 2017. Her taxable income for the year is $27,530. Using the tax table in Appendix A, calculate her gross tax liability. So I'm going to turn to Appendix A. The first part of Appendix A is our tax rate schedules. And my phone is ringing. Let me turn that down. There we go. Our tax rate schedules. We use, and that's page A-2, we use the tax rate schedules and A-3. We use those when our taxable income is over $100,000. Well, her taxable income is $27,530, so we're not going to use those. We're going to turn over to the tax tables. And looking at our tax tables, on the very, let's go to page 5. It starts out with the $3,000, so it goes from $3,000 to the $11,000 area. There. So looking at the columns at the top, we have at least and then but less than. So in the at least column, to go into the very first line below that, if their taxable income on line 43 is at least $3,000 but less than $3,050 and they're single, then their tax is $303. Let's turn to another page. Here we go. I just turned the page over and I'm looking at the top of page A7 in the at least but less than. So at least $21,000 but less than $21,050. If they're single, their tax is $2,688. Just go into the single column. If they're married filing jointly or if they're qualified widow, $2,221 is their tax liability. If they're married filing separately, it's usually they're going to be about the same as single. And if they're head of household, $2,486 is their tax liability. So, if somebody's taxable income is $21,050, that's not less than $21,050. So we got to go down to the next line. At least $21,050, but less than $21,100. Then, if they're single, $2,695. So that's how that works. So if we look at her, $27,530, still on this same page, I'm going to find $27,530. You guys go ahead and find that. $27,530. And if you haven't found it yet, go ahead and pause the video until you find it. And then once you find it, we'll turn it back on. She is single, single taxpayer. It's $21,050. I'm sorry, $21,530. Yeah, $21,530. So I'm going to look at line 27.5 to 27,550. Her tax is going to be $3,663. So that's how that's calculated. If you need to review that, go ahead and rewind if I spoke too fast or something like that. Otherwise, I'm going to go on to my next example, which is the one directly above Meg's example, and that one starts with Carol. Carol is a single taxpayer claiming one exemption, has adjusted gross income of $120,000 and taxable income of $105,000. So we don't care what her gross income is, adjusted gross income. We want to know what her taxable income is, $105,000. So I'm going to go over to page 3. $105,000. She is single as well. So these are separated into Section A is single, Section B is married filing jointly, Section C is married filing separately, Section D is head of household, married filing jointly or qualified widow, by the way. So let's look at the very first line. If her taxable income is at least $100,000 but not over $191,650, which is where she falls, we're going to use that first line. So it says enter the amount from line 43, which is her taxable income, $105,000. I need my calculator for this one. $105,000 times column B, which is 28%, so 0.28. That's what goes, so 29,400 is going to go in line C. And then line D, we need to subtract from line C 7,018.25. So 7018.25 subtract gets us 22,381.75. So that is the amount of tax that she owes for the year. And just so that you know, when we're doing homework, we don't round. But when we're doing tax returns, we don't ever put the zeros, the pennies in. We always round to the nearest whole dollar. So 50 cents and above, we round up. Below 50 cents, we're going to round down. So that's how that works. You're going to have lots of problems, so I highly recommend that you go through these examples. Make sure that you can figure that out. If you have any questions, you're welcome to contact me. There's lots of the homework problems are going to have you calculating tax for this chapter. And that's it.